Hello, everyone. Today we're going to talk about what real estate prices and what the real estate market is going to be like in 2024. One from an investor standpoint, and two from a potential home buyer standpoint. So, if you're somebody that's been sitting on the sidelines and thinking about buying a house, but the rates were so high you didn't want to jump in, so you've been continuing to rent, 2024 might bring good opportunity for you as mortgage rates are expected to fall. And I'm going to bring up an article here that talks about that. All right. So, National Association of Realtors forecast 2024 mortgage interest rates to average around 6.3%. And that's at least 1% less than what it averaged last year. Last year, we were mostly in the sevens to close to 8 in the late summer, early fall. So this would be a substantial decrease. And for every 1%, you're bringing something back like 8 or 10 million new potential home buyers, meaning that they can afford it at that payment with that interest rate. So with housing prices expected to be pretty stable or maybe up a little bit, this might actually bump it up a little bit more. So we're really going to see here between, let's say, February and April of 2024, how much the housing will go up, because generally people are buying in the second quarter, but the first 2 quarters are out there looking and potentially buying. So we'll see how quickly, one, the rates drop, and because they've dropped pretty significantly here over the past few weeks, especially with the Federal Reserve becoming much more dovish and look like they're going to be cutting rates at least 4 times next year, which should help the bond market, should help the 10-year treasury, and it's going to help all assets, help real estate, help stock market, help the crypto market, silver, gold, etc. Anything that's a hard asset will go up in value as the money gets devalued, because they are devaluing the currency by reducing the rates. But seeing that we're basically in a recession now, or if not close to a recession, they're trying to hedge their bets and trying to protect the market as much as they can and get market money back into the markets, mostly the stock market, but it'll go in all assets, as I said. But 6.3% is a good start. You're going to get some people who can potentially buy a property again, your first time home buyers there, people who've been blocked from being able to buy because of, one, pricing, and two, interest rates. And they were hoping the higher interest rates would reduce the price, but it hasn't, because the inventory is so darn low. And inventory is probably not going to be increasing anytime soon in most markets. And let's talk about what Fannie Mae believes is going on in the market here. They believe that the economy is on a shaky foundation, so they think there's going to be a crash, but not really a crash in real estate so much per se, right? Unemployment will expected to go up. We'll see if it affects real estate year over year here, but right now we're at a median home price. Let's find that data here. Here we go. Share the screen with you. 420,000 is the median home price. I believe the peak was June of 2022 at 425,000. Don't think we're going to be able to get above that 425 unless things dipped into the fives. Because here's what happened. If you get into the fives, you're opening up even more potential buyers out there. And then you're going to create bidding wars like we've had in the past. There's still bidding wars this year. I had bidding wars on properties I was selling. Still seeing them even here in the fall into the early winter time here, or almost the winter time at the end of the year here. So it's still happening, but that would really accentuate it and make it worse, especially if it's in the spring market when you have more buyers than properties out there available for sale. And inventory is increasing. Yeah, it's up 2.3% from last year, but that's not that much. We're still 34% lower year over year in inventory than we were in 2019, that pre-pandemic times, right? A more normal market. And that was still a big time seller's market as well. So keep that in mind. We're more than 50% lower than we need to be. With the mortgage rates increasing, look at that, we'll probably have more bidding wars on nice properties, desirable properties. If you're an investor, you won't necessarily have to do a high scale fix and flip. You could do more lipstick, paint, carpet, a wholesale type thing, and you will still do well on properties. That is our model. It's been our model for 4 or 5 years now, and we're only going to continue it. That's pretty much everything we're doing. other than maybe a buy and hold. I'm trying to really reduce how much rehabbing, because rehabbing time, energy, it's hard to find contractors. It's cost capital is more. So all these things reduce your profits, and you want to turn as quickly as possible. And this is a great way to do it. Let's look at foreclosure activity, because that's a factor here as well. So as you see, foreclosures from their peak here in 2007, we'll call it, to 2011, then you start to drop 2010, 11. And then we hit the peak of the bottom of the market here in 2013. And then we've gone up, but foreclosures have dropped, plummeted here because of COVID. But now you see they're on a nice steady increase, and nothing crazy up, right? Just a nice steady increase. That trend should continue. We'll see how long this continues, but I would say it's going to continue to slightly up, flat, slightly up, continuing to increase here. But no flood of foreclosures is going to happen. Just not happening unless the market totally tanked. Jobs are lost, all kinds of crazy things have to happen. Black swan event type stuff. So that's what we have here. So even with foreclosures increasing a little bit, it's really not going to give any more inventory. Now, one factor we could have, let me see if I can find this article here. Housing market updates. Here we go. Okay, so this is something to keep in mind. Nationwide, 25% of home buyers search to move to a different metro area between September and November of 2023. So these are people looking to potentially buy somewhere else. And again, the trend has continued to be where it was, where people are really trending to move to Florida. They're looking at the Carolinas. Maine has been a popular spot as well. A little bit of Las Vegas, getting 0% income tax, and Sacramento, California, for staying in California. Sacramento is one of your more affordable, nicer areas to be. So that's where people are moving to. And again, people moving from, pretty simple, San Francisco, California, Los Angeles, all the big metros, and Seattle, Chicago, that are run like absolute trash by bad politicians, bad policies, high taxes, poor living, not enough police because everybody's defund the police. So you got nothing but problems and issues with politicians and people here. So they're leaving and going to safer, better, nicer areas where they can raise their families a little more peacefully. Or at least that's what they hope. So with 25% of home buyers looking to move out to a different location, that's telling me there's still a lot of pent-up demand for people to move to the Sun Belt for the most part, or just to a different area, period, where they weren't able to. They felt they were locked in because of the rates. So you might have a nice little perfect storm here of decreasing mortgage rates, giving these people opportunities to then go buy where they want to go, which means Florida will again stay pretty hot, Texas, Tennessee, the Carolinas, Nevada, and Arizona. I'd imagine those would all be very hot markets still at this point. So things are looking pretty solid there. Let me just give her the screen share. And the market's looking pretty solid. To me, I expect it to be very similar to 2023, but maybe even a little bit better. So we went up anywhere from 2 to 3% on average in 2023, depending on where you were. This is nationwide average. I'm thinking more like 4 to 5% potentially, and maybe even 6%, depending on what rates do. It's really rate dependent and inventory dependent, as you know, supply and demand and the cost. Because the cost of living, cost of everything is going up so quickly that it's pricing people out of being able to buy homes or rent. Now, lastly, how will this affect rentals? So for each drop, more buyers are coming in and buying homes. There's less demand for rentals, which means rentals will drop a little bit, but not enough, right? There's not a flood of homes available that people can buy. And there's not enough home building going on to basically take care of all the demand that's out there, the buyer demand. So I think rents will be fairly stable, maybe drop slightly, but not much, and maybe even increase because everything could be going up with inflation. And that would include rents. I know the rentals I have, we're actually increasing them here for 2024, and some significantly. So we will see. It depends which market you're in. So we'll see what goes on here. We'll see what happens. But that's my outlook for 2024. I'm seeing a very positive, for the most part, even with the down economy, a positive housing market. If you're looking to move, now it's going to be a great opportunity for you. If you could pick up mortgage rates in lower sixes or in the middle to upper fives, would be tremendously good. Any big dip, I would say lock in and get right away as quickly as possible if you're looking to buy. And from an investor standpoint, it's going to be good opportunities to fix and flip, to buy and hold, maybe refinance out some of those rentals you bought last year at higher rates if you don't have prepayment penalties on them. All right, guys, that's all I have for today. Gearing up here for Christmas holiday times. I'm going to be traveling to New Jersey and out for about 10 days, but I'll probably do a video or two here or there during that time. Take care, guys.